All right, so today's webinar is going to be all about analyzing and underwriting your multifamily deal. And with us today is myself, Dan Handford, as well as one of our managing partners with PassiveInvesting.com, Danny Randazzo. Glad to have you here, Danny.
Glad to be here.
Awesome. Well, looking forward to it today. And for those of you who are watching the recording, anything that we discuss or have any links to anything will be inside of the comments. And also, we would encourage you to leave a comment below the video. And also, if you're on our YouTube channel, subscribe to the YouTube channel so you can not miss any of the future projects that we do as well. So let me I'm already on the shared screen, so I thought I had to switch over, but we're already here. So we're going to be talking about a high-level overview of analyzing and underwriting large multifamily assets. If you're watching the recording on YouTube, we're going to include some links to some other webinars that Danny and I have done together that go into a lot more detail and specifics when it comes to the multifamily underwriting. There's actually a part 1 and a part 2 that I'll send you a link to so you can get some deeper dive into some of the underwriting on some of these larger multifamily assets. So we're going to go into some other things, some things that you should be looking for when you actually are reviewing and looking at other operators' underwriting models. And then we're going to go over a tool that our team uses for our own underwriting. And then we'll also give you some target ranges for some various metrics that you might want to be looking for inside of a T12 that you're reviewing. And of course, as usual, we always add in a few little additional pieces of golden nuggets, like I like to call them, different little nuggets of wisdom, if you will, throughout the rest of the webinar today. So let me turn it over to you, Danny, and have you kind of talk a little bit about why it's important for a twofold investor, a passive investor, but also an active investor, to really be able to understand and be able to analyze and underwrite some of these larger multifamily assets.
Yeah, the most important part to it is being able to understand, not necessarily you need to do the actual underwriting in Excel or in another program. I think that is very valuable, but at a high level, you need to understand the functions of underwriting so you can make the best decision for your capital or your investment. And whenever I talk to someone about investing, it's always about what their goal is. So if you are looking at investing passively or actively in multifamily assets, what is the real reason why you want to invest? Do you want to invest for cash flow? Do you want to put capital away to get some tax savings? Do you want to, invest for long-term goals of paying for, college tuition for kids? Or do you want to build up your equity and create some wealth for you and your family and have it survive for generations? So you need to understand what your goal is. And then number 2, make that best decision. And in order for you to make the best decision about your money, again, it's your money, it's your investment, you are responsible. You need to have a basic understanding of the analysis and the basic underwriting fundamentals that go into a deal. So when we talk about underwriting and we talk about analyzing an asset from a pure numbers perspective, we're not going to talk about the market. I'm not going to talk about the economics of a market from job growth, population growth, but I'm talking the pure numbers of that business operation, right? Our 200, let's just say 200 unit apartment community, you want to understand what the historical operations has been like. That's that T12, the trailing 12 months performance, which basically it's like a P&L statement, but it shows all of your top line income. So how much income comes in from rent? Is there a vacancy loss that is accounted for? Is there some sort of bad debt? Bad debt is typically when people can't pay for their rent and they get evicted. That would be bad debt. Or if you're giving some sort of concession, maybe you have an employee unit and you give them $100 off a month, you would have a minus 100 in your top line income. So it's important to understand where that income comes from. and then the basic fundamentals of the expenses. So if you think about the house that you live in or the apartment that you live in, you have the exact same expenses, just on a different scale with multifamily. So you still have some sort of landscaping, you have some sort of repair and maintenance. If you move out, you would have a turnover expense, right? That's the cleaning, that's the refresh of the paint, touch up of the walls. You're going to have cable, internet, electricity, water, trash. All of those basic essentials are still in a multifamily property. It's just at a bigger scale. And when you have 200 units, you can control those expenses a little bit more. So from an underwriting perspective, understand where the previous owner was at with their income, with their expenses, and what's that NOI. This is how multifamily properties are valued. It's all based on the NOI and the local market cap rate that properties trade at. So with that basic understanding, when you're evaluating an investment opportunity, either as a passive investor, right, someone who is just going to invest money and get a return, or an active investor, if you're trying to purchase a deal, own it, operate it, and be a syndicator, you need to understand what your goal is with that asset. So for the assets that we buy, value add opportunities, we are trying to increase the income that a property generates. And when we underwrite a deal and when you evaluate an investment opportunity, either as a passive or an active, you want to have conservative evaluation of potential income gains. And what I mean by that is if you're doing a value add project, you do not want to become the market leader. At least I don't believe in it. You can have the nicest unit in a market, but I would never underwrite to be the market leader in terms of rent price. You always want to be conservative in being just a little bit below the competition. So you want to have the nicest asset, but instead of renting for $1,200 a month, maybe you're going to rent for $1,175. And what that does for you as an operator or as an investor is it really protects the integrity of your occupancy. So one of the main reasons why you would want to invest in multifamily assets is for the monthly cash flow that the assets produce. And in order to have monthly cash flow, you need to maintain strong occupancy. So I would always look at, when I'm evaluating a deal, what is the projected income? Is it achievable in the market? Meaning it's not going to be the market leader and it's a little bit below the rest of the competition. So I can, with ease, maintain the occupancy that we need to have, mid 90% occupancy with that asset to have a conservative income projection. From the same standard, I would evaluate my projected expenses in the future against where I'm currently at. Multifamily assets, unless there was something that the previous owner or management company was doing egregiously wrong, there's not a ton of ability to cut expenses drastically. There are some areas where you can certainly improve, but from a conservative underwriting approach, I would never look at a deal and think that a new owner can reduce expenses by 50% compared to the previous owner. So I would evaluate those line by line. And like Dan said, we go through the details in those part 1 and part 2 of the underwriting very thoroughly on the expense side and what some of those kind of average projections are per unit, so you can size up a deal. But I would always look at that, and if the new owner or the new investment opportunity is projecting significant expense reductions, I would ask questions of why. And if they can't be easily explained, such as, the previous owner had to hire triple the staff because of, a catastrophic fire and units were down and things like that, I just wouldn't expect that a new owner can can magically reduce expenses in a significant fashion. I think there are some savings, especially if the property is older. Maybe you're putting in new electrical and new plumbing fixtures, which reduce usage. That's a natural reduction. I could see maybe 10 to 20% savings in that specific category. But typically, I would look for, again, conservative income projections, conservative expenses. And, I would always look for, is that property, where are they coming in at versus the competition in rent per square foot? And I'm going to pause there for a breath.
Yeah. So for those of you who are watching live with us, if you have questions as we're going through some of this stuff today, I want you to feel free to put them into the Q&A box or the chat box, however you wish to do that, because we want to make sure that we're answering some questions that you might have when it comes to some of these assets. So we're going to go for a few more minutes and talk about a few more things. It looks like there is one thing here. Is the T12 similar to what a rent roll would illustrate? If not, when is the benefit of looking or using the rent rolls?
Yeah, the rent roll is a phenomenal tool. And again, it should be another component that a syndicator or a general partner would look at when evaluating a deal. And so when we evaluate a T12, I always check the top line income every single month. And then I'll evaluate a current rent roll as of today, or maybe within the last 2 weeks, depending on when the broker has that information. And I would look at what's their occupancy? What do they collect in a rent roll? Does the rent roll match to what their previous 12 months of income has told me? So if the rent roll says that they're 98% occupied on 200 units, but the income collected over the last 12 months is at about 70% occupancy, that to me would be a red flag. And a red flag means I have questions. Versus if the rent roll is at 90% and typically over the last 12 months, they've collected about 90% of their gross potential rent, the GPR, then the rent roll to me makes sense to what the T12 tells me. So it's a story that you have to piece together, and you cross-check the story to identify any red flags. So again, if the rent roll is saying that they're fully occupied, but the T12 is saying that they did not collect all of their gross potential rent every single month, then something doesn't add up. Something was wrong there.
Yeah. There's another question coming in here from Ed. How would you approach valuation of an apartment building where the tenant rent roll or the tenant rollover has been so low that rents are about 50% below market?
Well, typically in a primary market or a large metro, I think you have pretty consistent turnover. So I'm kind of making the assumption here that if turnover is low and rents are 50% below market, I'm thinking you're in a secondary or tertiary market, and you may have trouble attracting new residents. But I would also think that there is some value add to that opportunity. I would really just evaluate, how many units is the property, how many people live in that community, how many people have jobs that are that can afford to rent from you. And I would also wonder what the current owner is doing. Why aren't they trying to push rents? And if you can answer those questions and have a good confidence that if you marketed a property for a 50% rent increase, would it fill up? I think you could have a good opportunity for a value add investment.
Yeah, and I think the other thing from this standpoint too is obviously valuing a property that is at 100% occupancy, like you're mentioning here, Ed, that the rents are low. Are you going to have to pay a little bit of a lower cap rate because of that? Depends on the demand for that property in that market, but chances are you may have to pay a little bit of a lower cap rate because of that built-in value add. But it shouldn't be a significantly lower cap rate, but you may have to pay a little bit of a premium because there is a lot more value add available to it, especially when it's organic like that, where based on the rent roll and the turnover, you can increase those rents and still have that value play. Would you agree, Danny?
I would.
Yeah. Next question that I have here is I know a couple of weeks ago, this is Wilder asking the question, we had talked about and did a demo of CoStar. Are there any lower cost options to CoStar for analysis? And I'll answer this one for you. And if you want to add a few things, Danny, you can. But I would say that before our group had CoStar, we worked very closely we still work closely with our property management companies, but we got a lot of these CoStar reports given to us statically. So we weren't able to have the dynamic, look into the property from having the access ourselves to CoStar, but we got a lot of this information from the brokers and from our property management companies that were able to give us a lot of the information and the data. But you can also go to websites like citydata.com, city-data.com, or go to places like Rentometer, or there's a couple other
CIA
Reonomy.
Factbook is another one for population growth and stuff like that. And census.gov, I think, is another one.
Yep.
Google is a good one.
Mm-hmm. And somebody's asking, what about LoopNet? And I don't believe LoopNet actually has data like that, or it just has listings and stuff. I can't remember, but does CoStar own LoopNet?
Yes, they do.
I was going to say, so yeah. CoStar actually gets a lot of their data even from LoopNet as it is.
Yeah. The last fact I heard about LoopNet is that about 1 or 3% of properties show up on LoopNet, and the other 97% plus are on CoStar. So the free LoopNet service has this many properties versus the CoStar paid service has the full picture.
Yeah. Another question coming in here from Philippe. This is one for you, Danny. What if a property doesn't have a T12?
I would work with the broker, the property manager, and the seller to get a T12. That is not an acceptable answer. I know there are mom and pop owners out there, especially when you get under 100 units, where maybe it's their only apartment community. They have to have something. Right? Because they don't just collect income once a year, right? They collect rent probably every month, and they pay bills probably every month. So they should be able to put something together. There's a lot of a lot of scrutiny that I would have if they do not have a T12, because they could miss expenses that you're going to encounter. And there's definitely opportunities to make sound investments in those mom and pop operations where they kind of do things on the back of a napkin, if you will, or in, on paper. But I would work really hard with them to understand how the property is operating. And again, you need to use your judgment to say, okay, how many units is there? How much do they rent each unit for? How much income should they be collecting? And they could show you bank statements of deposits and kind of match it up that way. You're definitely going to have to put more work in, but with more work means less competition, right? Because the people who want the easy button aren't going to spend the time to do it. So I think you might be onto something, but just do your diligence and know exactly what your costs and expenses should be for that property, regardless of what the seller gives you.
So I do want to get to showing you the model that we use so that you can kind of see it. We'll spend probably 3 or 4 minutes reviewing that just so you can kind of see from a high level perspective. And I'll share my screen, Danny, with that model because I have it set up here. That's kind of all blanked out and stuff, empty or whatever. But I'll have you kind of walk them through it and give you the controls. But there's 2 questions that I want to have. I've kind of cherry picked here. And if for some reason we don't get to your question, we'll try to follow up and post on our various platforms a response, and so that you can still get the answers to the questions that you guys have. There's 2 questions here. So first one I would say is, let's see, how many units on average should you turn per month for a value add?
It depends on the size of the property. Let's just say you have 100 units. Again, I would go back to your goal. Is your goal to have cash flow and maintain 90+% occupancy? Well, if that's the case, and you have 100 units and you want to maintain 90% occupancy, it's just a math equation. The 10% vacancy that you would have would mean you would turn 10 units a month, and you would do that over the course of 10 months. 10 times 10 units a month is 100 units. So you would be through your units. Likely, you're going to have leases that are 12 months in duration. So you're not going to get exactly 10 a month, but that's how you set up your business plan. You think about what the goal is. And so if the goal is to convert a community from a C to a B, maybe you want to drop occupancy to 0. Or to 50%, and you're going to do half of the community and then the other half, or you're going to do all of it at once. But figure out your goal and figure out what occupancy you need to maintain, and then do the vacant units each month.
So the last question I'm going to take here is from Jason. He's asking, how do you adjust for renovations that significantly drop the NOI versus the previous year's T12? So I'm a little confused by the question because usually renovations is a below the line number. So it doesn't usually affect the NOI, except for when you increase rents after you do renovations. But, and I'm not really sure. If I was doing renovations and it dropped my NOI, I'd probably stop the renovations because it's not really doing what we want to do. But I think if I'm reading that correctly, are you reading it a little differently, Danny? Got it.
Yeah. So, again, I would look at it and try to understand the story. So, what is that property doing? Why did occupancy drop to 55%? Are the units that are renovated not being rented? Meaning residents in the area are not absorbing those units. They don't want to live there. Either the renovation is not good, the rent is too high, or it's a combination of the two. And I would think if that's the case with a 55% occupancy at the property from a previous owner doing renovations, I would have a really hard time looking at that asset and saying it's a good opportunity, because it seems like something's wrong. Either the residents don't want to live there, people don't want to pay as much. And like Dan said, if they're not going to pay, you need to stop doing renovations.
Yeah. All right, so I've got on the screen here, you guys should be seeing the Excel spreadsheet. So if you can see the Excel spreadsheet, just type in the chat box, yes, 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 or raise your hand, however you'd like to do it, just so I can make sure that you guys can see this okay. All right, we got yeses all across the board and lots of hands being raised. That is great. Awesome. So Danny, I'm going to turn it over to you and spend maybe say 3 or 4 minutes, and let me turn over the controls to you as well, so that you can go ahead and control this and kind of move around a little bit. But just kind of walk us through just a few of these little different tabs here. And for those of you who are watching this right now, this is a model that we're actually giving inside of our VIP toolkit for the Multifamily Investor Nation Summit that's coming up on January 16th, 17th, and 18th of 2020. So if you're interested and you want to register for the summit, you can go to mfinsummit.com. And when you go there and when you go to the checkout page, you'll see a place to be able to add on the VIP toolkit or the VIP access. And this is one of the 4 spreadsheets that we'll be sending to you for that add-on. And the add-on is only an extra $100 for the various spreadsheets we're going to be sending to you and things like that. So Danny, let me turn it over to you. Just let you walk through a couple of slides here, probably spend 3 or 4 minutes, and then we'll go ahead and close it out.
Perfect. And can you reduce the maximized view? I can't see the bottom tabs in Excel.
Does that work at all?
No, if you that'll work.
All right.
Okay, so on this tab here, if you can bring the perfect. Okay, so this is kind of our summary tab. So once you've looked at everything, this table really identifies the high level information that people are interested in. And as a general partner, this is where we review the outputs of each deal. So we have a property summary, which kind of tells us the purchase price or our target acquisition price. It gives us a cap rate that we're buying it at. We have the number of units, the square footage, the vacancy, the general property information. And then we have our financing assumptions. So what type of debt are we going to use? What's the interest rate? What is our LTV or loan to value or LTC, loan to cost, depending on the type of product that we would be using, either permanent agency debt or a private bridge loan. Up in the top, we have kind of our sources and uses summary. So this is really important when we look at the right side of the table with purchase price, what's our closing costs, our acquisition fee, and then CapEx and reserves, which gives us the total cost to purchase the asset. And then, on the left-hand side, we have the LP equity. So the total funds that we need to raise, and we have our debt, which gives us a summary. And so the sources and uses is a way to figure out what's the total project cost and what is the amount of equity that we need to raise for the deal. Where we go next is, again, kind of that project summary. So we're doing a 5-year hold. What's the CapEx breakdown from interior, exteriors, and then your total rent premium, average rent premium, target exit price, all of that information. And the most important part on this spreadsheet here is this return summary section. So it gives you the limited partner or investor IRR, internal rate of return, the LP cash on cash, the LP annualized, and the LP equity multiple, as well as the unlevered and the project IRR. So why is this the most important? Well, this is how we evaluate the types of returns and if a deal meets our criteria or does not from an investor perspective. So typically if a deal is below a 10% IRR, we're probably not going to be actively pursuing it. We make sure that each deal, as we underwrite, and again, having that conservative income that we talked about earlier and our conservative expenses, we want to make sure that our investors can achieve the returns that they expect for each project. And so we'll use this return summary section to really understand and evaluate how the investment is going to perform, and is it a good fit for us, our group, and our investors, or is it a deal that we need to pass on? Or do we need to go back and adjust our target purchase price to be a lower amount if we can't meet our return? So again, you're going to be out there, if you're an active investor, brokers give you the their opinion of value or what the kind of target trade price should be. And you need to go in and evaluate and figure out what you need the target acquisition price to be to make your numbers work. And so that's why underwriting and analysis is so important, because a couple of small things here or there from an income side or an expense side can mean not hitting your returns. And so you need to know the ins and outs. If you're going to be an active syndicator, you need to know the ins and outs of income to ensure that you're underwriting correctly. And if you've not closed a deal this year and you've said every deal has been a bad one, you probably need to go and watch part 1 and part 2 of the underwriting series so you can learn a little bit more, because I'm guessing your assumptions or your underwriting is either way too conservative or you're missing some very important information. With that, I just want to cover the other important tab, the inputs tab, real quick, Dan, if you want to jump over to that. Again, this tab is really where we put the most important information to evaluate a deal. And so we have our assumptions. If you could just zoom out a little bit, that way we can see a little bit more on the screen here. Perfect. So on the right-hand side where we're looking at the assumptions, so is there a transfer tax that you're going to pay? What are the typical closing costs? So this is your attorney fee, your lender fee, your taxes, government fees, title agent, title insurance, all of that good stuff in your closing costs. And then you've got your operating capital and interest reserve, your debt information in there. We can keep scrolling down in these assumptions. I think I have control here.
There you go.
Perfect. Yep. So then you're looking at inputting what your stabilization assumptions are. So is this a 5-year hold? Is it a 10? Is it a 7? What's that cost per door to renovate? Number of units that you're going to rehab, your exterior budget, your going in vacancy, and then you've got other fees that you will incur. And so you need to get those inputted correctly for your underwriting to work. And on the left side, if we can scroll to the left, on the left side of our inputs tab, again, this is a very important section here because you are inputting the historical T12 information from the seller, and then you are developing your stabilized assumptions for expenses. And so, as I was saying earlier, it's just not reasonable to slash expenses by 50% compared to the previous seller unless they were doing something completely wrong. But having those conservative assumptions, going through and having, again, conservative underwriting above the expense T12 section on these annual expenses, you have the income assumptions. And so that's what we talked about earlier. And having an underwriting sheet like this one is very useful because there's only a few areas where you need to input and make updates to it. And then on your summary tab, you have all the summarized information right there at your fingertips to evaluate how the deal is doing. And so you can kind of jump back and forth and then take a look at your monthly or your annual P&Ls and some of your sensitivity information here to see how the deal is going to perform in a stress tested environment.
Well, that was a great overview of this model. And some of you have been asking about, can you show other tabs in the spreadsheet? And, do you guys have access to this? And this is available for those of you who register for the mfinsummit.com. That's coming up in January, and you register for the VIP access. So you do have to have that add-on in order to get access to this, but we'll be glad to, send it over to you once you register, and that's mfinsummit.com. Before we wrap things up, Danny, I know we were going to go over the different expense inputs. So for those of you who are watching this, or when you're going over the recording, go ahead and get your cell phone out right now, or your print screen button, because I'm going to show you a spreadsheet that Danny put together on one of our last webinars that gives you kind of some general market ranges for some of the expenses that you're going to see on the T12. So you can take a look at that and have that information available to you as well. So Thank you guys so much for being a part of the webinar today. And thank you, Danny, for joining us as well. I actually asked Danny, I think last night or yesterday sometime, if he would be able to help out, because I didn't prepare very well. So thank you for coming up on such short notice for us, Danny.
Happy to do it.
Well, for those of you who are watching, we're going to send out the replay of the recording here and try to answer as many of your questions as we can on some future videos. And in the replay video, I will give you access to I'll give you links to the other webinars that we actually did with Danny that will share with you some additional deeper dive into the underwriting. And for those of you who are interested in investing with our group passively, would love to have you join us on our next project and our next offering. And we do accept accredited and non-accredited investors into some of our offerings. So you can just simply go to passiveinvesting.com, fill out the investor questionnaire, and my assistant will call you to schedule a phone call, personal call with me to be able to discuss your investment goals. And looking forward to seeing you guys next week at the next webinar, which I'll send out here in the next couple of days. So thank you so much for joining us, and we'll see you at the next webinar.